Hello, everyone. Today on the final bar, we will wrap the week. We'll focus on how the markets have evolved from last Friday to this Friday. It's been all about rotation, but even more so about a resilient uptrend. The S&P once again making a new all-time closing high today, closing around 41.85. The question is the sustainability of this uptrend. And when we look at some of the charts today and look at how things have evolved in our Mindful Investor Live chart list, you'll see that breadth overall fairly supportive. Ladies and gentlemen, this is the final bar. Hello, everyone, and welcome to today's edition of The Final Bar. I'm your host, David Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Washington. Thanks for joining us every weekday after the close as we look at these markets together using the power of StockCharts, focusing on the message that the markets present as reflecting all of the investor psychology, all the fear and greed, the euphoria, the desperation, all those emotional drivers of investment decisions and how they are manifested in stock prices. The most important thing we can follow, I would argue, and many of my mentors taught me, is price. Price does not lie. Price does not change. It reflects reality. So we're going to go through the course of today and focus on some of the messages of the markets themselves and overall the S&P continuing to push higher. As you probably saw, maybe from the intro video, I'm back in StockCharts HQ here in Redmond. We're doing so rarely. We're in the process of reopening our office in the coming weeks and months, which we're super excited about. We have a beautiful studio here in our office that we are anxious to get back into. Having said that, we have some really good content continuing to come out every day and really every week on StockCharts TV. Coming up tomorrow is our Options 101 panel. All this week has been Options 101 week on StockCharts too. We've had some great, educational, instructional videos by Tony Zhang, by Joe Duarte, by Daniel Shea from Simpler Trading. Really well done, just helping you, get inside their head a bit in terms of how they approach things. Tomorrow, we will finish off the Options 101 week with a special panel. I'll be hosting a discussion with Price Headley from Big Trends, from Lex Luthringhausen from Tradier, which is an options brokerage, and Sean McLaughlin from All-Star Charts and Trade Ideas. I'm gonna ask them the questions that you would want to ask them if you're just trying to get into options. How do you get started? What should I keep in mind? What are some mistakes beginning options traders make? I'm going to pose that to that panel of experts, and very excited to hear their take on things. Go to stockcharts.com/options101 if you want more info on that. On this show, three great guests next week: John Kosar from Asbury Research on Tuesday, Frank Capilleri from Instant on Tuesday, and then on Wednesday, and then on Thursday, Sam Stovall from CFRA Research in New York. Let's get to our Wrap the Week segment. This is where we focus on the movements of the markets themselves and try to get our head around how the markets have changed from last week to this week. And, really, I would say it's not just about this last week, but about the last series of weeks. The last 4 to 5 weeks have been about an evolution from value over growth to growth over value, from small cap leadership to small cap laggardship, from breadth measures being mixed to breadth measures being more positive. There's been a lot of movement, and I think what you're seeing now is a lot of charts at really interesting places. When I'm thinking of things like banks and airlines, they've pulled back to ascending 50 to energy companies. They've pulled back to ascending 50-day moving averages. The question is, do those hold, and do those charts resolve higher, or do they fail? What you're seeing from the banks is that they're holding just fine and rotating back to the upside. That's impressive. What you're not seeing that yet is places like airlines. Delta reported earnings this week, not really bouncing off of support like others. So I think it's a group by group thing to see how these different charts are evolving. Overall, we'll look at what happened today, and then we'll focus on the weekly trends, and then we'll get into the Mindful Investor Live chart list and go through as much as we can, given our allotted time. Overall, the S&P finishing higher again, a new all-time closing high, 41.85. And it's funny. It's how long ago we were talking about 3,700 and whether we'll be able to get above that key level, and look at how we're 500 points later, we're still pushing to the upside. pretty much everything higher in terms of equity indexes. It was just scales of positivity. The strongest of the indexes we track here on our front page was the mid cap index, up almost 0.8%. The NASDAQ, probably the weakest of the bunch, just above zero. The VIX is almost at 16, which is the lowest it's been in a year plus. Other asset classes very quickly. Let's look at today's move. Yields back higher. Yesterday came off pretty good, and that was a nice bounce in bond prices. Bond prices back down today. The dollar down as well, but just a little bit with the UUP below 25. Gold and precious metals back up. We're going to look at the chart of gold here in a little bit because it's one of those, it's actually setting up in a pretty positive way. Gold we think of as sort of an inflation hedge. And when people talk about inflation concerns, but gold really isn't doing anything, my comment is I'm not seeing that. I'm not seeing people worried about inflation or you see gold prices go up. You're actually starting to see that rotation higher, little swing highs, new swing lows, and that indicates some concerns about inflationary pressures going forward. Cryptocurrencies mixed. Bitcoin probably the most widely followed, down today, bouncing in the last half of the day, but overall nearing the 62,000 level from below here. Let's look at the week during the show. We're starting the clock last Friday, and we're going at the next 5 days, and we're seeing what's actually happened with these different asset classes. We'll start with the S&P 500. You'll see a cluster of lines here. So the S&P, the NASDAQ, and emerging markets are all kind of on top of each other right around here. This is around 1.4% or so, and that was a return on the large cap index, the S&P. What outperformed stocks? Gold up 1.9%. How many times in recent months, if not years, have we talked about gold outperforming the S&P? It's happened. It's happened today when we look at the last 5 trading days. Two things, definitely outperformed: crude oil and Bitcoin, both of which up over 6%. Looking at the last 7 days or last 5 trading days, going back to April 9th. What has underperformed stocks this week? Bonds, just a little bit, up around 1.3%. Small caps only up 1%, and this is that continued rotation, away from small cap leadership we've seen continue today. And then the dollar is the only one out of all of these major ETFs we're following that was actually down 0.6%. So that stronger dollar rotation is one of those things that had been certainly emerging. This week was a little of the opposite. You've seen bond prices higher, rates lower, the dollar lower, and most other things net positive over the last week. Let's continue our Wrap the Week segment looking at the Mindful Investor live chart list. If you've not seen a Friday show before, this is a chart list that I keep updated every week. We review it on the show every Friday. If you've not seen it before, go to the articles tab at the top of your screen, go to my blog, which is called The Mindful Investor, and you'll see a link at the top that says live chart list. This will get you back to the chart that we're going to review here. So we start off with the S&P market trend. This is looking at 3 different time periods, all using weekly data. So it's the long-term, medium-term, and short-term models are all based on different weekly exponential moving averages. And another time I can get into more of the mechanics of it, but overall, the long story short, long-term, medium-term, short-term, all positive. The long-term model has been positive since June of 2020. The medium-term model had been negative from around mid-February, but turned back positive 2 weeks ago, 2 Fridays ago, turned back positive. And so that's a thumbs up. The short-term model has been positive since late February. So when all 3 of these are positive, again, it's not predictive. It's telling you what the trend has been up until today. But in general, I found when this model is green across the board, that is the time you should feel fairly comfortable getting into stocks and charts and ETFs that look attractive. This is telling you that thumbs up, you have the green light to explore and look for opportunities as warranted. When the medium-term model turned negative about 2 months ago, that told me to be a little more cautionary, to hesitate a little bit on looking at new long ideas, because there was a chance, a non-zero chance that the market would show material weakness from there. Really, it had not materialized. As you know, the S&P resolved to the upside, shrugged off some of the bearish divergences we'll look at in a moment, and at this point, the model is all positive. The daily chart of the S&P really shows this pattern of rallies and consolidations. And I think of this last year in sort of a series of impulse moves in the direction of the overall trend, sort of sideways moves. You have the first big move from the March lows up to the June peak. That was sort of one phase. You then had this pullback phase for about 6 weeks, it was about 2 months, where you pulled back to the 200-day a couple times. You bounced above resistance, found support there, and then broke to new highs into September. Chapter 2 was this next phase where you have the sideways consolidation here. This is when things like financials and energy stocks and others out of nowhere start breaking out to the upside. The market overall breaks out of that consolidation phase in November and moves to new highs. And that's where 3,700 was the level we talked about for months, was really that magnet level for stocks. Since then, we've essentially had a pretty significant consistent rise, really haven't broken below the 50-day moving average with any consistency from that time. We've pulled back a number of times. Those have all been fairly attractive entry points during a long-term uptrend. And now we've had a couple weeks of really no pause in the uptrend. And anytime that happens, anyone who has managed money for any amount of time will have my reaction, which is I'm ready for a pullback, right? Pullbacks happen. If you have not pulled back in a long enough period of time, be ready for one. And it doesn't mean to sell things aggressively. It just tells you to be wary and look for signs of internal weakness. Look at stocks that aren't working and take some off the table there. Because here's the thing, if you're all in now and you don't have any cash for when the market does pull back, this is why institutions are looking to raise cash in this sort of move, because the problem is when the market does pull back 8 to 10%, which would happen at some point in the future, you want to have an opportunity to buy in on that weakness. And if you're still all in, you really don't have an opportunity to get into things that start to look really attractive. So the concern now is, where are you lightening up? Where are you looking for opportunities? And in general, I'd be in stocks that are working with improving relative strength. I'm leaning away from things that have not been working. That's the general thesis I would be on. The S&P is overbought right now. That has a lot of implications. We don't have time to go through all of that today, but I did record a video on my YouTube channel, which is called Market Misbehavior. Check that out. I posted a video this week about the overbought conditions and talked through how that relates to historical conditions and what you might want to expect going forward. So check that out if you didn't see it. The breadth picture overall is very supportive, but it depends on what group of stocks you're looking at. And in general, if you're looking at the largest stocks, the S&P, the mid-cap index, these advanced decline lines continue to make new all-time highs along with the market. And again, the market going to new highs with these advanced decline lines making new highs is the sign of a healthy market environment. That's kind of what we're seeing right now. As long as that persists, as long as that pattern continues, there is very little you should be worried about. What I'm looking at, though, is that the small cap advanced decline line has not quite confirmed that, has not broken to new highs. The microcap index, we don't really track a microcap AD line. I think that might be a sketchy data set to probably even try to put together. But if you look at the microcap index, the IWC, it's not confirming a new high recently. So the S&P making new highs, but other indexes not, is where you can, that's maybe a bit of a concern. That's something to watch. So whether or not the S&P the small cap advanced decline line can make a new high next week would be an interesting thing to watch for. I'm open to the discussion on new highs. I've heard some people looking at this chart here saying, as the S&P is going higher, there are less and less new highs. I'm not necessarily seeing it that way. I'm seeing the S&P go up and there's a healthy amount of new highs. These green bars up here tell you that on a good up day, when the S&P is closing higher, it's about 15 to 20% of the index of the S&P 500 that is making a new 52-week high. That seems pretty positive to me. I see that as being consistent with previous bull market phases. I don't see that as a negative. The S&P going higher, but it's only like 5% of the S&P making a new high. That for me is more that's a check in the concern column. I'm not seeing that here. I'm seeing plenty of new highs. This isn't updated for today just yet. But Thursday's close, you had 18% of the S&P making a new high. I can't see that being a net negative by any stretch. Also, you're seeing strength and again, these are all breadth measures using the S&P 500. That's why they look so positive. If you look at the percent of S&P stocks above their 200-day, it's about 96%. Look at the percent of S&P stocks above their 50-day moving average, it's about 93%. Those are both pretty positive numbers, right? S&P making new highs. And, what's happened is back here at the beginning of March, when we pulled back, only 50% of the S&P still was above its 50-day moving average. This is when the S&P itself actually closed below it for a day. Now, 93%, almost the entire S&P has now recovered, which means 43% of the S&P has gone back above its 50-day moving average in the last 6 weeks. That, to me, seems like an overall positive signal. Let's look at sentiment a little bit here. So if you're looking at the AAII survey, these are individual investors. This is survey data. So literally, investors are asked, are you bullish, bearish, or neutral on stocks in the next 6 months? And basically what this is telling you is it's over 50%, which for me puts it in the euphoric category. It's certainly elevated. It has gotten much higher, and at times it's gotten up to 60 to 70%. This is back in 2003. If you go back that far, you'll see it up that high. So it's not the highest it's ever been, but overall it's telling me sentiment is stronger than average, and I should be looking for signals that the trend is exhausted. I'm not seeing that signal yet, which is the sign of trend exhaustion. Active money managers, this is the name exposure index, have gone from 50% long to almost 100% long in the last 2 weeks. It's a pretty big swing in that indicator over a 2-week period, and indicates that money managers essentially have gone from tapping the brakes to stepping back on the accelerator and pushing to the upside. Ridex funds, by the way, are at the highest level, really the lowest value that they've been in history, which is essentially saying it's an extreme level of bullishness. We don't have time to go through all the ratio charts, but I'll just highlight a couple very quickly before the break here. Number one, semiconductors making a lower high there on the relative strength, the relative performance of semiconductors versus the S&P. Charts like NVIDIA are making new highs. That's great, but the average semiconductor stock is not. That's an area of concern. That's sort of a bellwether group, and in general, you want that group to be doing better rather than worse. Other trends have really maintained their trends. Small caps continuing to underperform large caps. That's the chart we just flipped through here. The equal weight S&P underperforming the large cap S&P, and growth back to working over the last month. We really haven't seen a rotate back into value in any meaningful way. That's something I would potentially be looking for into next week. Do we see a return of rates increasing? Do we see a return back to the value trade? That is our Wrap the Week segment for this Friday. We're going to take a quick break, back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. I've mentioned, if you've missed it in the intro, I usually look outside the window and see what the weather is. You've probably heard me say sunny Redmond for many of the last couple of weeks. I've learned now from being here a couple years, I'm sort of in my second year out in the Pacific Northwest. You have kind of half the year, shorter days, a lot of rain. The other half of the year, absolutely stunning with long days that don't seem to end, and plenty of sun and clear skies, and fingers crossed we were more in that part of the year. It's certainly been a great last week or two here in the area. As a reminder, we love to hear from you. We're going to open the mailbag here in a moment. Shoot us any questions that you have. We'll do another mailbag segment on Tuesday's show. Our email is thefinalbar@stockcharts.com. That's the best way to get your comments in front of us, and I look forward to hearing from you. Also, as a reminder, the new Stock Charts TV on demand is live and running. It is really well designed. I'm proud of our team. Our Stock Charts TV team did a fantastic job elevating the content that our hosts and our guests are providing every trading day. Go to stockchartstv.com, use your email, set up a free account. You can consume all of that for free on our website, also on any of your mobile devices. Let's open the Final Bar Mailbag, answering questions. These are all questions we've gotten from you in the last day or two. Let's get to it. First question, David, I have a question that's been confusing me lately. Yesterday, the whole group consumer discretionary was down, but I was looking at your equal weight versus cap weight ETF chart list. The ratio RCD to XLY went up positively. Can you explain the implication of this? Yeah, so this is a chart list that I featured, it might have been last week or so. It's this one down here, and it's a really cool list. What it does is it basically shows you for the S&P, what we often do is look at the cap-weighted S&P versus the equal-weighted S&P, right? So RSP is an equal-weighted ETF, SPY is a cap-weighted ETF, and by looking at the two of them relative to one another, you can see if it's the larger stocks or the smaller stocks in the sector that are doing well. You're asking in particular about this chart, which is doing that relationship on consumer discretionary. So here, the RCD is the equal-weighted ETF going up. At the bottom is the XLY, which is the cap-weighted ETF. When you ask this question, which is sort of a couple of days ago here, you say the whole consumer discretionary group was was down, but this was up a little bit. You're talking about this little bounce here. Yeah. So what happens is this has nothing to do, this top ratio has nothing to do what the sector overall is doing. That's why I have the other two on here. So this shows you what the sector itself is doing. And it's also not telling you what the sector is doing relative to the S&P. That's a separate chart you might want to look at. This is basically just saying within consumer discretionary, what's working better, the larger stocks within there or the smaller stocks within there. If this line is going up, that tells you it's the largest names, and consumer discretionary is dominated by three stocks: Amazon, Tesla, and Home Depot. So if this line is going up, probably those three stocks or a couple of them are doing really well, and that's most likely pushing it higher. If those are doing poorly, the cap weighted version is going to go up less or go down more, equal weighted version, and so that's what's going to cause this to go down. So if this line is going up, the smaller part of consumer discretionary is working better. If this line is going down, the larger parts of it, the big mega cap names in consumer, are working. So if the consumer discretionary sector does whatever, but if this line bounces up, that tells you that it's the smaller parts. It's not the big mega cap names, but it's the smaller stocks within the sector that are doing better than the mega caps: Amazon, Tesla, and Home Depot. I hope that makes sense. It can be a little bit confusing. If you have questions, let me know more, but that's basically what that does. Just helps you understand within the sector, should you be looking larger or smaller? Next question: is there a preferred time to use ratio analysis, stock A versus stock B, over percent change analysis, comparing two symbols based on the percent change in price from a single reference point? If the line graph for stock A versus stock B is in an upward trend, stock A is outperforming stock B, but stock B's percent change in price is greater than that of stock A, how does one analyze this data? Yeah, it's kind of a busy question, so I'll try to have it make sense more than anything. What we'll do is at the bottom, what we're basically doing is saying Newmont versus SPY. Let's change it from SPY to let's FCX, right, which is Freeport-McMoRan. So two material stocks and how they're performing relative to one another. So if this line is going up, that means Newmont is outperforming Freeport-McMoRan. If this line is going down, Newmont is underperforming Freeport-McMoRan. This line is going sideways. They're performing the same relative to one another. When you're doing this sort of ratio chart, I have this set as price, price hyphen performance, and it's showing you percent. What that's actually showing you is it's not saying if you bought Newmont and sold Freeport-McMoRan, what would the spread be between those two? Because it's actually showing the percent change from the starting point, right? So if you were actually holding those two stocks, you would want to do a different calculation. In general, though, they're pretty similar a lot of times, and the direction of this line is what's more important. So if this line is going up, stock A is outperforming stock B. If the line is going down, stock B is outperforming stock A. And that's really the main thing that we're looking at with relative performance, is how is one thing doing relative to one another? And the values are less important than the direction. It's all about the direction of that ratio, because the numbers can mean a lot of different things, and we're actually not really good. Humans are not great about interpreting what that value actually means for you and your portfolio, if that makes sense. So I've often found, just look at the line and look at the direction of it. You want things that are going up, and you don't want things when they're going down. So what that means, it has nothing to do with the prices of the stocks themselves are doing. So if both of them are going down, but Newmont is going down less than Freeport-McMoRan, this line is still going to go up. So you don't want to think of this as a directional indicator. It's an indication of relative direction. So that's why you always look at the price of the stock. I will often look at the performance relative to the S&P, because that tells you what this stock is doing relative to an entire universe. And then something like this, relative to the sector, relative to another stock, relative to another group, can be really helpful to see. If I own stock A over stock B, which ones has helped me out in the look back period that I'm paying attention to? I hope that makes sense to try to answer your question. Let's see, your observation, please, on, let's see, I'm not sure what stock you were actually referring to. Let's see if I can quickly bring up an email and see if I can find this one. DKNG, DraftKings, and you said, hope you had a great vacation. We absolutely did. Thank you for the well wishes. Oregon, if you've not been there, rent a cabin out in the woods, go hiking. It is absolutely stunning, and there's no cell reception, which is our favorite part. DraftKings overall, so here's the thing. DraftKings looks a lot like the less attractive stocks right now. And the reason is because a lot of things are going higher. Microsoft going higher, gold stocks even rotating higher, making a higher low and a higher high in the short term. DraftKings is one of those few stocks making a lower low and lower high in the short term. It's now broken below its 50-day, arguably tested it and rolling over. So all else being equal, I would be less excited buying a stock making a new swing, a lower high and having the relative strength turned down. However, it's right at that point where it's not broken yet, right? It's not going up a ton. It's not that it's going down. It's just, it's not going up a whole lot yet. I think it's what this is potentially setting up as is sort of a head and shoulders top with a high surrounded by two lower highs. And we're pretty close to breaking that neckline. I would give it a little bit of room just because it's sort of a choppy sideways period. But if it gets much more below where we're at, and especially if the RSI breaks below 40, that to me would validate more of a downside move. It's concerning some of the charts that have that type of pattern. In the short term, airlines kind of look like that a little bit. And so that's a bucket of stocks that they're not horrible yet. So, holding them doesn't, I can't argue too much with it. But again, holding stocks where the relative strength continues to go down, it just tells you you're not anywhere near the best opportunity. And so that's how I would maybe interpret that particular chart. Thanks for the question. Final question, and then we need to wrap the show here. I'm going to summarize because there's not quite a lot of time for it. But basically, you said, is there a way to stretch out the chart so you can project? Let's say you want to draw some trend lines out in the future and project where DraftKings is going to go. So the answer is you have some capabilities within our Sharp Charts tool, and I'll tell you what you can do. At the very bottom below here, there's this little thing that says extra bars. Now, while that doesn't add vertical space, what it does do is it gives you blank space on the right side, so you can draw some potential future paths and illustrate it. Otherwise, it's right at the y-axis, and it's hard to do it. In our ACP platform, you can actually do it very easily. What you do is left-click on the y-axis, move it around, left-click on the x-axis. You can drag things around and do all sorts of stuff. That sort of functionality we are working on building into our Sharp Charts platform soon, but not today. So you can do a little bit inside the Sharp Charts. Just go to that extra bars feature in ACP, just left-click and drag, move things around, and you're done. We need to wrap the show, folks. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is Bitcoin. Overall, I can't disagree with the long-term sort of bullish technical thesis. Something like Bitcoin had a consolidation period. In this period here, a coil pattern of lower highs and higher lows was a sideways period after breaking up to 60,000. If you look, it took about 2 months for Bitcoin to get above 60,000. I would argue it's now broken above there, and you can see higher highs, and now the question is, as we pull back to 60,000 again today, do we make a higher low? And that's what I would be keyed in on. Remaining above sort of 56,000, the ascending 50-day moving average, that has served as support on pullbacks going back for the last couple months. I would certainly be looking to see if the 50-day holds. So around 56,000 is a good, decent pullback where the uptrend is still in good shape, and that's what I'd be looking for on Bitcoin. Chart number 2 is Newmont Mining. Gold has rotated from downtrend to uptrend. It's actually a pretty nice potential rotation. I certainly was talking about the bullish long-term gold prospects for a while. It hasn't been a good trade for the last 6 or 7 months, and that's been, obvious. We've talked about lower, a downtrend when so many other things were going higher. So it's not been a great place to be overall. However, we're starting to see that change. A lot of people think of gold as an inflation hedge. When I interviewed Walter Deemer, former technical analyst at Putnam, has been in the industry for 50 plus years. He talked about, gold being his favorite indicator of inflation concerns. Don't look now, but in the last month, you've seen that rotate higher swing lows, higher swing highs. You're seeing this break above trend lines, and Newmont Mining finally has broken above this trend line that's been going for about 6 months. That's actually an interesting setup at a time when you're not seeing as many out there. Finally, you asked about DraftKings, one of you, and this chart here, which is the Jets ETF, the airlines ETF, looks a lot like the chart you just showed me, where it's almost showing this sort of head and shoulders like top. It's made a lower high. It has not made a lower low yet. It's remaining above the 50-day moving average. Banks like Goldman Sachs have bounced beautifully this week off that 50-day. My question going into next week, can airlines do the same? Folks, that's a wrap for this show and a wrap for this week on the Final Bar. Thanks so much for joining us every weekday after the close as we break down the action of the markets. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good weekend.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.